Morning, Joel. How's it going?
Pretty good, Mel. Pretty good, Mel. It's been a very, very chaotic 2 weeks in my industry. So happy to have a chat with you. It's funny how it coincides with what seems to be a fairly quiet period of time for politics in our country.
We had a break week last week because the November Remembrance Day is always off. So both federally and provincially in Alberta, there were no new pieces of legislation introduced or anything like that. So it tends to be like sort of a break week of reprieve. And based on the discussion that we had last time about budget, I kind of needed it. So yeah, happy for it to be more market focused today. But we do have a couple of political things we'll chat about that are budget related too, actually. So we'll get into that later on.
Yeah, absolutely. So, I mean, maybe I'll dive into kind of where we're sitting in terms of market price action. For the last couple of weeks, we've seen a dramatic shift in sentiment. And the resulting of that has been gold is now the number one asset in terms of performance year to date. And Bitcoin is now the worst. And we haven't seen something like that for a long period of time. We're now looking at a reality where you have the S&P 500 just yesterday closed below its 50-day moving average for the first time since April 20th-ish of 2025. And that kind of caps off what seems to be the fifth longest uptrend in 75 years. So we had a pretty momentous move off of April lows and in the S&P 500 specifically. And it's resulted in, I think, some people being offside in terms of their risk and perhaps being a little bit too bullish heading into the final few months of the year. That's not to say that this wasn't also likely caused by a bunch of events that maybe some folks listening to this podcast were not privy to, but for myself, it's something that is obviously top of mind. Sam Altman was very recently on the BTG podcast with Satya Nadella, who is the Microsoft CEO. And on that podcast, they were kind of going back and forth about their new ownership structure as they've now been able to finalize the conversion from being a not-for-profit to a for-profit entity. They were able to kind of outline for the market the ownership structure where Microsoft owns like 25 to 28% or something along those lines, and how everybody is now incentivized moving forward. This is a crucial step to them perhaps going public in 2026. And during that period of time, you had Brad Gerstner, who is a very loud and I think a obvious supporter of OpenAI. He's a shareholder. His fund Altimeter is and has been the company for a long period of time. And in this interview, he goes and he chats with Sam and he asks him, so Sam, you have 1.4 trillion in capital outlays over the next 3 to 5 years. How exactly are you going to finance that when you only have presumptually 13 to 30 billion in ARR? And this shocked Sam Altman somehow. A man
he was visibly shaken in that response.
Yeah.
I remember seeing that. Yeah.
It was kind of odd given that this is probably one of the most prolific fundraisers in the world who has sat in front of the most important and intellectually deep investment committees to raise capital from the most sophisticated people. The fact that this bugged him so much spooked the stock market. And
because it's not a particularly crazy question to ask. Like if you're somebody, it's a pretty standard question. Even people running much smaller companies with much lower stakes could expect investors or people who are watching their company to ask such a question.
Certainly. And I think what threw him off most was the fact that Brad is clearly a supporter and shouldn't be throwing these questions at him, presumably. But the reality is that he was just being a good podcast host. And his answer was poor. To add insult to injury, they had the following day, the CFO went out and asked or misspoke and said that they might want government security to help them raise debt. And this all just, I think, poured gas on a fire that didn't need more gas. And interestingly, I actually view this as being a very healthy moment in this most recent bull market, because the sad reality is that if they just kept slowly feeding the fire, this AI trade likely would have continued upwards, grinding upwards for 6, 9, 12 months, and we wouldn't have seen a digestion of this most recent historic move. To me, when you have investors questioning investment dollars and questioning the we'll call it the plan that they have and whether or not there's going to be return of invested capital, I think that that's a healthy market to be in. So as a result of this interview, and I think further news releases post, the market has started to roll over a little bit. There's more doubt. And while I've just said that I believe that to be very healthy, that doesn't change the reality that this starts to pick up steam, and nothing is more interesting to media outlets than something failing. Whenever you see the opportunity to pile on and push to gain clicks and for shares, and this is exactly what the media machine has been created for over the last 15 years. And
if it bleeds, it leads in the stock market, right?
Exactly.
Yeah.
So just recently, there was 2 economists cover pages where they were talking about the stock market going into a massive drawdown. And that tends to be a fantastic time to buy stocks. It's quite the opposite. It's not a great time to sell. But with all that in mind, I think I want to maybe touch on, okay, you have these outlandish, and we've been talking about it on this podcast, capital outlays, where they are committing an enormous amount of capex to building out a ton of data center infrastructure. And it's right for the market to ask, is there going to be a return on invested capital? And what I want to point out to people that are market participants, CEOs, et cetera, is that there's 2 really important examples. And I'm going to go through 2 quickly. You just recently had Microsoft, Google, Meta, and Amazon report earnings. They each individually have issued bonds to the market to continue to build out their AI infrastructure. They pointed out in their calls that there has been, on average, a 10-point incremental increase to return on invested capital based on their current build out of their AI stack. That, or their server farm, whatever you want, their AI factory, however you want to refer to it.
I like AI stack.
Okay, that is an important note, that they have currently seen an acceleration of profitability based on the capital deployed into this portion of their business. Now, I also want to say that that does not mean that let's call it, and be generous, OpenAI and ChatGPT, for those that maybe don't know the 2 companies being the same, has a annual revenue run rate that is shy of being able to afford a, call it, $1.4 trillion build out. Now, can they issue stock to do this? Can they raise money in different ways? Absolutely. But they also have levers to pull in order to generate revenue that they have not even begun to we'll call it, look at. Now, I also want to call people's attention to I think a past example, an analogy that I think works well with ChatGPT and OpenAI. This is not me saying buying OpenAI is a good idea, by the way. This is just me saying that folks that value companies based on their perception of total addressable markets in traditional ways tend to miss out on innovation that changes the entire market. A great example of this would be early 2010s and Uber. And you had some of the most prevalent and some of the greatest value investors in the world suggesting that the total addressable market of Uber can't be much more than whatever the market for taxis is. And that seems logical. Many folks were valuing the business as though it was going to take 10% of the taxi market. The taxi market was valued at about $100 billion worldwide. It was generous, but sensible to say, you know what, Uber is going to be valued at a total at a multiple based on a total addressable market of 10% of the taxi market. Okay, fine. They were at that time doing $2 or $3 billion and in revenue, and people were valuing the company between 5 and 15 billion. That seemed fine. Just this last rolling year, they did about 175 billion in revenue. The reason for that is because they didn't just provide a similar service to one that taxis were solving. They created a whole additional experience, one that was better and enabled folks to remove or spend money that they were spending differently, whether that be on trains, whether it be on vehicles themselves. The way in which we spent our wallet share moved. It changed the improved experience, the innovation, the marketplace drove additional revenue and additional total addressable market. That is exactly how people need to think about disruptive technology. You cannot limit them based off of the technology market that they're disrupting. It is very silly to not, and this is where human beings do such a terrible job of dealing with exponential growth and exponential numbers. And that continues to be true in growth investing and the current technology side of this stock market. Now, again, I want to readdress the OpenAI situation. This is not me saying that for whatever reason the $1.4 trillion capital outlay is justified. It doesn't mean that OpenAI should raise money at $1 trillion and it's a good investment. That's not what I'm saying. All I'm saying is that folks that are doubting OpenAI's valuation, that are doubting their ability to accomplish the goals that they're setting out for themselves, are also missing the point. It's okay for you to be skeptical. It's healthy. It's good for markets. However, I do caution folks in treating Sam Altman the same way that Travis Kalanick was treated with Uber. I also want to draw people's attention to Elon Musk's Tesla. Elon and Tesla, everybody was valuing it, and I was guilty of this too back in 2015, 16, 17 as a car company. I don't think it's fair to say that Tesla is a car company anymore. It is more than just car deliveries. It is FSD, full self-driving. It is battery company. It is robotics. It is artificial intelligence. It is a whole host of additional business lines inside. And that's the failure to see that as an optionality, and a CEO and a management team that's able to deliver is a failure of a good growth investor and a good and somebody who perhaps is able to see where the puck is going rather than like where it has been in the past. So kind of back to this current market, we've seen a massive run up, especially in the we'll call it the high beta AI artificial intelligence stack specifically, where you've seen Micron, NVIDIA, Broadcom, Oracle, the large, we'll call it big 7 companies having a pretty significant run up while the rest of the market has not participated. And I think it's very healthy that we're starting to see a little bit of a sell-off. Now, we are nowhere near some form of like massive market correction. I think a sell-off here is very justified. And I mean, if we're just being honest, I mean, we got Meta that's maybe 26, 27% from its all-time high. Google's only 4% from its all-time high. Apple's only about, let's call it 8 or 9%. Microsoft, roughly the same. We are not anywhere near recession and or major market correction territory. This volatility is very, very, very expected and something that should happen. And it's healthy to happen every 1 or 2 quarters. So,
I have questions. Okay. I have 2 questions. I have one about recessions generally and one about how people are thinking of OpenAI. And I'm going to start with the latter. So everything that you just said makes a whole lot of sense to me. I think that I think we talked about this last podcast about when there's so much going on in the world, you can't just look at one data point. You really do have to look at patterns and like the broader history and even challenging your own assumptions. When you're talking about what's going on with OpenAI and some of the other companies and how it's maybe some people who don't get it are missing the plot. It always reminds me of that Mark Twain saying, it's not the stuff that you don't know that gets you in trouble. It's the things you think, the things you know for sure that just ain't so. That really struck me in terms of what you're saying about OpenAI, because I think being curious and questioning, I think this is important both for markets and understanding what's going on in politics. There's been so many shifts that have happened in the world, some influenced by government policy, many actually. But yeah, we can't solve the what's going to happen in the OpenAI space problem or question with 2010 thinking, or even, 2020 thinking. So I thought that was really interesting. And I think that's like a good trick for people to be using, not just when they're looking at markets and economics, but in politics too.
Yes, absolutely. You really need to see, or this is why understanding where your blind spots are is such an important, I think, if you're a CEO or you're a person that's representing a board or on a board rather, or in an executive position or an entrepreneur of sorts, identifying that you have blind spots and then filling it in with folks that see the field differently than you do is an asset to that leader. And and then from my perspective, it's very much an asset to me from an investment perspective. I like the fact that I have people on my team that come into my office and they're like, you're wrong, or this is why you need to see things differently, because it helps. We all have our biases, we all have our blind spots, and it's really, really important to be able to identify those.
Totally. It's all about like the feedback loop of like inputs and outputs. And I think like the second question that I have for you, just in terms of your high level thoughts, you are talking a lot about the bull market and how the markets have been performing right now. There's lots of talk, obviously, about people wondering if we're going into a recession or not. And I don't want you to necessarily predict whether or not that's going to happen. But I did read a really interesting article last week in The Economist that talked about the fact that we experience fewer recessions than we used to. I just wondered if you had any thoughts about that or anything to say about that. Like the article, just to summarize, and we can even link it in the show notes, just goes into talking about the fact that obviously, if you're an investor and you don't want to see a recession, sometimes you do, but they perform this sort of needed reset and even from Joseph Schumpeter, this creative destruction opportunity in markets and economies. And I wondered what you thought about that, or if you had anything that you're thinking about in today's context as it relates to that.
Yeah, I don't feel like it's even it doesn't, my opinion on whether or not we're going into a recession or not is actually doesn't really matter much, because markets are not necessarily tied to the economy and the economy is not tied to the markets, especially in the United States. Now, with that said, I do believe that there is two concerning issues at the moment, where we have a K-shaped economy in both the US and Canada, but definitely more obvious in the US, where you have some stark winners and some stark losers. And you can start to see that percolating in the employment data. You can start to see that percolating in the shipping data. You see it in railcar data. You start to see it in restaurant data. That is a concerning reality. Same thing goes for new house starts, especially in the US. Housing affordability, perhaps the advent of a new mortgage that needs to go out to service that grouping of people. We'll call it mortgage duration, sorry. The reality is that you have an economy that is slowing down. You have a Federal Reserve in the US that has become increasingly more hawkish the last 3-4 weeks, citing that they are, and rate cut assumption has now gone down to about 53% come this December, where it seems like price and goods prices is more a concern to the Fed than unemployment. And they're ignoring a lot of this underlying data that maybe this is a result of the government being shut down for many, many weeks, but they are not reacting the same way that they have to unemployment for the last 9 months. Now, the market right now, I believe, is pricing two things. The Sam Altman's chat, which obviously turned into a number of other headlines, and everybody starts to pick up on certain hedge fund managers selling certain stocks, et cetera. But Also, they're picking up on the Fed hawkishness, which they believe, and I think the market thinks, that they're making a policy mistake where they're not cutting into a unemployment issue. Now, in Canada, we don't treat employment the same way that the United States does. It's not a dual mandated Bank of Canada, where the Federal Reserve does have that. However, that to me can be a concern. For the last multiple years, and to address your question, we've seen a market that has oftentimes caused a recession, whereas the economy has not caused the market to go into a prolonged bear market or downturn. It's quite the opposite.
Interesting.
And so when The Economist mentions that we have shortened our we'll call it perceived recessions, I think that has a lot to do with financial engineering and our understanding of liquidity in markets. Oftentimes recessions occur because folks are scared to spend money. And the speed in which information, and I think the interconnectedness of markets and consumption has shrunk our recession timeline, where with market moves, we've seen that similar to the taper tantrum or the tariff tantrum of April, where within 70 some odd days, we were back to and or near all-time highs. It's no different than the 111 or 120 days from peak to trough to peak during COVID, where our Federal Reserve, our politicians or financial engineers, so to speak, are able to come to the rescue. We have understood, rightfully so, that liquidity is what causes recessions. People's fear and unwillingness to come to the rescue, you need to have a buyer of last resort, that last resort being the government, oftentimes, where they are there to backstop and ensure that our financial system is not going to crumble. We have learned this lesson through the very challenging 2007 to 2011 time period, and we have shrunk that recession time period. Now, that isn't to say that we couldn't see a prolonged recession where our government no longer has the ammunition or the liquidity to come in underneath and solve for that liquidity crisis that often is the cause to a recession. So I would say that I think the reasoning, without reading that article specifically, the reasoning for that is liquidity, our government's financial tools and levers that they're able to pull.
Okay, I have one more question on this. Sorry, this is really fascinating. I feel like we should continue to talk about this topic because I think it's really interesting. We didn't plan to talk about this, so maybe we can shelve it for next time too. But when you look at what drove the 2008 financial crisis and that the idea of like too big to fail and all that, I wonder. One question I would pose to you, and just to like kind of keep in the back burner for us, is like, are the conditions that we experienced in 2008, like what would in today's current context, like what would have to be happening, kind of thinking back to the This Time Is Different book by Reinhard and Rogoff that's so good from Harvard. It's an interesting question to keep in the back of our mind. Like what kinds of things in today's context, updating our software basically, to what the reality is today, what kinds of things would we be watching for? Sorry, you don't have to answer that today.
I mean,
I think it's interesting.
It's such a challenging question to ask. It's like, what's up off the top of your head? What's the biggest risk? And the thing about financial risk is that it's not a risk if you can identify it, because you already know about it and you have a solution for it. So now, I mean, you really have to get creative with what you believe is going to be the cause. It's almost always, again, illiquidity, right? Banking is always where our nose heads, or where we believe it's going to occur. I think it's quite clear that the cause of a future recession is going to be economic activity slowing down. And if you can put fear into the consumer and the market and people everyday people's lives, that is when you start to see recession. So it can percolate anywhere, whether it be oil prices tend to be a very common. If you see $100+ oil prices, you start to see inflation, you start to see a slowdown in consumption, recession. You start to see spikes in specific commodity costs, cost of living, unemployment. All of these things that we are much more aware of today tend to be where those recessions occur. Now, where do I view there being the biggest risk to recession? I think, honestly, what we're not noticing and not paying enough attention to, and perhaps this is not the case for folks that support the party that isn't in power, but I believe there to be political risk being the biggest risk to recession, where we have a situation where the bottom half of the economy no longer feels as though they are being treated appropriately, especially in the United States. And there's some sort of revolution. Now, I don't think we're close to that, but that to me is a risk and a continued risk. I would also add the fracturing of the relationship between the United States and China. It's interesting. I started reading, I think I brought this up on our last podcast, but I started reading a book about how the similarities between the Chinese and the American cultures. And some folks don't necessarily agree with that, but it just couldn't be further from the truth. They're so similar. And maybe that's why they just seem to be enemies. But I do believe that the fracturing of that relationship, whether or not the Americans think that that is a healthy thing or not, is going to cause economic hardship in the short term, even if it means that it's better for the United States and maybe even better for the Chinese in the long term and their individual demographics. I just think that it's going to be very tumultuous and not only that, it's not a solution that can be fixed with interest rates being cut. That is a lot of trade that needs to be shifted, a lot of manufacturing that needs to move that isn't currently in place. So I do believe those to be the two major concerns for myself, and obviously Taiwan being another. I mean, if there's ever any sort of earthquake there or something that shuts down TSMC for any prolonged period of time, that is automatically a recession. And
all of a sudden,
The one thing I would add is that this stock market specifically is incredibly difficult to hedge. There aren't a lot of negatively correlated assets anymore. Everything as a result of globalization is so heavily correlated, where we have bond prices that, and I don't know if anyone remembers, but 2022, you had fixed income products that were down 10, 12%, while the stock market was down 30. Those used to move inversely. Now, So we now have very, very difficult situations where you can't leave money in cash because it deteriorates with inflation. You can't leave money in fixed income because it doesn't actually have a negative correlation to equities. And so there's not a lot of ballast there. We live in a world where we need the financialization of the world, where it's very challenging to protect yourself in periods of fear and volatility. And that's just a reality of time, of these times.
Yeah. So fascinating. I think the last thing that I'll say on that, and I think we should just continue to have this discussion over the next several weeks, because I think it's a really important topic. You mentioned liquidity causing recessions, and even with inflation, like we know this from political data, if people think that we're in an inflationary time, that can actually drive inflation. And so sometimes it's perception. So I think it's really interesting in terms of the behavior that people will have to respond to hedge as much as they can. As you say, that's maybe not as easy as people think, or to sort of be protective of themselves in markets. But it's interesting to look at it from a government perspective as well. I wonder, with governments with the moral hazard associated with too big to fail, and governments sort of being sort of more and more involved in these discussions, it's interesting because negativity can maybe protect you in markets, but governments don't generally want populations to be feeling the negativity. So it's just interesting to line up the incentive structures of how all these different parts work together. But anyway.
Well, I think that's the current inflation problem right now, wouldn't you?
Yeah.
Because we have a government that is unwilling to stop spending, which causes uncontrollable inflation. where you have a Bank of Canada and a Federal Reserve that is battling government spending deficits, and they are counter to one another. And what's interesting, though, that you also have to balance two opposite realities where you have, and I think that this is an interesting insight that I heard from the RenMac podcast just yesterday. They asked the guests on the show what they view as being more important to voters. So they're heading into the midterms in the United States, and it seems as though the Trump administration is going to start shifting its view on what's important, from being perhaps unemployment being important more so to goods inflation being important. And why is that? Because the people affected by unemployment are those that are unemployed. And that's a pretty small subsect of the population, relatively. However, inflation hurts everybody. Everybody feels it, whether you are in the top 1% or the bottom 10%, but still employed. Nothing hurts more than inflation. So you have a government spend that is required to sometimes satisfy some folks on the investment front, where they don't want you to cut spending in their areas, right? So it's this weird, delicate dance between politics and economics, where they are, unfortunately, they don't necessarily jive with one another all the time.
And I would add that the layer on top of that, as we've seen in many jurisdictions, is the morality aspect of that as well, of like the moralizing the government, of like, if the government doesn't spend on this area, they are, the people who are in that government that represent a political party are bad people. But then you have this divide and this K-shaped recovery, as you mentioned, continue to get bigger. You drive people further to their own extremes. People who, if you have a Democrat president, Democrats are going to become entrenched in what they think, and then Republicans will be more and more emboldened to say extreme things as well, to actually affect change and sort of break through the barriers that we have politically to get us to think differently. And you mentioned revolution earlier. I mean, I don't know that I would necessarily call the election of Trump in 2016 and again in 2020 a revolution, but you see those kinds of characteristics of like, okay, this is how we see just these responses that we almost can't explain politically. And a lot of it is connected from, the economy and markets and how they're interacting. So I think we should definitely keep talking about this. I could talk about this all day. It's so interesting. But
yeah,
I won't bore our listeners.
I know not everybody wants to talk about those dynamics that much, but I guess what I would do to kind of close off this market conversation a bit and away from we'll call it recession risk. I do believe that markets digest new developments, and you've had a pretty good 6-month run, and the market has to digest that run. And the market is currently doing what it always does after a narrative and a paradigm shock. It digests, it recalibrates, and then it reassigns the risk premium. And the reality is that tomorrow we get NVIDIA earnings. Everybody already knows it's likely going to be good. Now, that's not investment advice. It just means that all their biggest customers have already reported earnings. They have today just released a very interesting partnership with Microsoft and Anthropic. Anthropic being the third most important LLM, second to Gemini, and first place being ChatGPT and OpenAI. And it's this constant evolution of a new technological innovation, and our markets and the companies, whether they be incumbents or the new entrants, are battling for market cap and market share. And this is where our reality has headed, where things are way faster than they've ever been before. That same thing is true in politics, and that's why these things have come together. And perhaps this is where I wanted to head next, which is the Warren Buffett retirement. And I think the perception of his legacy and those sorts of things. And I don't know, I'd love to do an episode just about how incredible of a man, and I mean, I should say not man, but a leader from an executive position he was. And I think just he tended to be very honest with himself and with his investors, that I think has created a an aura about him, and I think cemented him as probably the greatest of all time. And I think that's awesome. But I do believe that his, like, the archetype of Warren Buffett is assumed to be essential for every other CEO and executive, and I just think it to be inappropriate and maybe not. There's different people belong in different roles at different points of technology and businesses, right? And it's sad to see him go, but it's also interesting to see the new management come into place and a new position be added to their portfolio that perhaps isn't normal for Warren Buffett, but definitely I think he's on his way out. He sells Apple, in not all of it, but a very large size, and then he adds a new position in Google, a consumer staple, so to speak. And now he's kind of on his way out and going to enjoy the last few years of his life. I think it's an interesting reality and an interesting storyline that I want to touch on with you, because I think you have a different perception of his retirement and a different perception of his legacy a bit than I might.
Yeah, I did. I wrote I think I wrote a blog post about this. Actually, I totally forgot about that, but I'll send it to you. But what I'm always super interested in is, of course, in every realm, whether we're talking economics, whether we're talking markets, whether we're talking politics, to be a good leader, I think you have to have a strong vision, which Buffett obviously did. I think you have to have a solid understanding of incentive structures, which he and Munger definitely did together. I think that the thing that I am most fascinated by from Buffett and previously Munger and just the whole kind of like Berkshire Hathaway sentiment, as somebody who's not as deep in markets as you are, is they, to me, have cultivated a model for the kind of sentiment that you need to be a sort of evergreen presence in their field. And I think about that a lot when it comes to politics. I think a lot about how, if you contemplate even just in Canada and the United States, when the last time that we had sort of a like really pivotal, like Kennedy-esque or like I just don't know if we look at leaders in politics the same way anymore. And I just sort of wonder if part of the reason for that is because we don't have we have a lot of interaction between politics and markets in terms of government intervention, but it seems that less and less we have business involvement in terms of somebody who's been excellent in the private sector wanting to make their way into politics. We obviously have a bit of that with Carney and certainly our natural resources minister, Tim Hodgson, and increasingly, definitely, as you see some of the staffers. I think this is just an interesting anecdote that you see in Ottawa. I think that there's been some disruption in terms of like what the normal trope of a staffer is, sort of like, I think, bringing a few more private sector folks into the mix. And I think it's very possible we could also see some more private sector folks enter the government as time goes on. I think if you're doing quite well in the private sector, you may not want to make that jump until you sort of see a level of stability and track record. So I just think it's interesting to sort of look at both Buffett's sentiment in terms of how he was so successful in his realm. And I also just like to look at different business leaders, as you were mentioning, have different sort of approaches and how they run their businesses, how they grow their businesses. Before we started recording, we talked about, the difference between Buffett and Musk, for example. They're both two different types of leaders. And I think you do see different leadership behavior and involvement in politics. Like, even though every leader and every business person has to make a significant effort in managing, sort of, as we say, anticipate, interpret, and mitigating political risk to make money and be successful in their own domain, it's just interesting to see how different leaders decide to get more or less involved in politics itself. Buffett really didn't get that involved in direct partisan politics, but he was no doubt quite influential. And I think probably, unless you're, very far left and hate billionaires, probably pretty widely respected on both sides of the aisle for his role. So I don't know if you have any thoughts about that, but I just think.
I mean, generally speaking, I do. I think that Warren Buffett had a unique perspective in that he was all about longevity.
Mm-hmm.
He was willing to play the long game. And that's why he never had or spoke on politics. And he realized that every 4 to 8 years, you have a different party in power and you can't get behind another. And when you are a long-term investor, somebody who, and this is kind of what I wanted to point out, is that there's different duration and incentives based on time horizons. You have Warren Buffett that had a time horizon of infinity. And then you have folks like, we'll call it our politicians, that have 2-year, 4-year, 8-year time horizons. And the reality is that you need to perform and get reelected. And Warren Buffett never had that. He was in control. He never had the risk of being fired. The incentive structure wasn't never such that it was share price based, or he had to hit a bonus by this month. Whereas you start to look at the incentive structures of CEOs and our politicians, and even folks that are innovating, you have time periods where you need to win in order to get to scale, so that you are the product that dominates the mind share of the customer and the larger base consumer. These are all different factors that you need to consider when you're making an investment or voting somebody in. The sad reality of our politicians is that when if you need them to make hard decisions that benefit over the long term, they're never going to do it, because there's no incentive in place to do that. There's no politician that's able to tell that story, because their storytelling is never good enough. You have folks that sell short-term change so that they can get in now, right? And that's why we've found ourselves stuck with folks that run massive deficits for eternity, because that's the easiest path forward, and you just kick the can down the road. That same thing has not been, or hasn't plagued long-term holding company CEOs, like people that run Fairfax, Constellation Software with Mark Leonard, and Warren Buffett, Berkshire Hathaway. And I think that's really important to understand. I also would add that the reason why Elon Musk is so great, and I don't think everything about him is great. I do believe that it is inarguable to say that he is an incredibly competent and an incredible CEO and builder and entrepreneur.
Correct.
He has accomplished things that I don't think anyone would have ever believed was possible. And in order for him to do those things, he has to make very short-term, abrupt, difficult decisions. And he has this ability to aggregate the greatest people, best minds, incentivize them, get work done as fast as humanly possible, and do very hard things. And that sometimes requires him to, I think, do extreme things, whether that be on the political front or in terms of like cost cutting, or doing very, very hard build outs in terms of choosing different states, whatever. If you just look back from like a 30,000 foot view and try to figure out what exactly he's trying to accomplish, you can start to understand why he does what he does. And I don't believe that he necessarily thinks that Donald Trump's the greatest person to run the United States. I honestly believe that he felt as though he was his best chance at getting certain policy through. Just like very soon, you're going to start to see the need for FSD, or full self-driving, being passed in multiple states and more broadly and nationally. And the best way to have that done is to have the ear of the executive branch and the administration. So like, no wonder he used his social platform to get this person into office. This doesn't mean that it's right. It's just, you can see the incentives, right? You can see the incentives that have caused certain outcomes. And maybe we need to rethink our incentives if we want more people to be like Warren Buffett, who I think is inarguably a morally pretty stable person. But I don't know. That's kind of my perception of it. I'm going to miss having him. I'm going to miss listening to his annual shareholder meeting. I'm going to miss reading his quarterly letters.
Totally. No, I think all of that sort of tracks with me. I think to sort of end on this note, I think that's perhaps from my perspective, in my small c conservative values, the greatest argument for decreased government intervention in areas is that we inadvertently create incentive structures that are very difficult to undo, that don't actually benefit all of us long term, and create the sustainability and stability, both economically and politically, that we know we want, but we mistake on how to accomplish or achieve.
Well, I think that, and I don't know if you read this, but did you read Warren Buffett's A Few Final Thoughts?
I read parts of it. I have to read it cover to cover.
Okay. Well, I think that this is just, I don't know, it speaks about his greatness. He's so darn good at saying a lot with little. Mm-hmm. So at the beginning of his Few Final Thoughts, he says, one perhaps self-serving observation. I'm happy to say I feel better about the second half of my life than the first. My advice, don't beat yourself up over past mistakes. Learn at least a little from them and move on. It is never too late to improve. Get the right heroes and copy them. You can start with Tom Murphy. He was the best. And then he finishes it off and he says, I wish all who read this a very happy Thanksgiving. Yes, even the jerks. It's never too late to change. Remember to thank America for maximizing your opportunities, but it is inevitably capricious and sometimes venal in distributing its rewards. And I just think that he does such a lovely job of every one of his letters, and it's nice. He did a good job, I think, with his final thoughts and his farewell. It was elegant. He didn't make it all about him, and he's handing the reins off to what's his name again?
Greg Abel from Edmonton.
Yes, Edmonton. Yes.
How cool is that?
Yeah, there is nothing cooler than that, honestly, as an Edmontonian.
Yeah, pretty cool.
Arguably one of the most important energy
Carney's
and insurance CEOs.
From Edmonton. Well, he's originally from Northwest Territories, but there's something in the water up there, I'll tell you.
Hardly. But I do think that we should hang our hat on that. Mel, I don't know if you have anything else you want to touch on.
No, I'm good. Hopefully I'll have more to raise in politics next time. We have a couple more weeks under our belts.
That's true. It sounds like in January there might be a leadership review. So.
Oh yeah, stay tuned, folks. Stay tuned.
Awesome. Well, Mel, is a
take care, Joel. Bye.